Welcome to ETF Fundamentals. Today, we've got a showdown between two powerhouses in the dividend ETF arena, SCHD and VIG. Whether you're seeking immediate income or building for the future, this matchup has it all. For your convenience, I've organized this video into chapters so you can easily jump to sections or revisit the charts and data whenever you need. Before diving into SCHD and VIG, let's briefly introduce the companies behind these ETFs. Charles Schwab, known for its quality and innovation, offers SCHD, the Schwab U.S. Dividend Equity ETF, while Vanguard, famous for its low-cost philosophy, provides VIG, the Vanguard Dividend Appreciation ETF. Both are respected names offering top-tier investment options. Now let's explore how SCHD and VIG compare in their dividend strategies. First, we have SCHD, which targets high-quality dividend-paying companies. Meanwhile, VIG zeroes in on stocks that grow their dividends year after year. Both are champions in their own right, but each offers their own unique approach. Both SCHD and VIG are guided by indexes. An index acts as a roadmap for ETFs, guiding which companies to invest in based on specific rules, such as dividend history or market size. By following an index, these ETFs ensure they invest in companies that align with their specific strategy. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which focuses on high dividend yielding stocks, perfect for those seeking a steady income stream, while VIG follows the S&P U.S. Dividend Growers Index, which targets companies that grow their dividends over time, making it ideal for long-term income growth. Both indexes boast impressive records. The Dow Jones U.S. Dividend 100 Index, with companies that have paid dividends consistently for at least 10 years, and the S&P U.S. Dividend Growers Index, with companies that have consistently increased dividends for at least 10 years. Which is a testament to the stability and growth potential for each ETF. Staying with the index strategy, let's dive a little bit deeper into these rules. SCHD uses a capping strategy, limiting any single stock to 4% and any sector to 25% of the index. It also selects stocks based on a 3-month average daily trading volume of at least $2 million. That ensures liquidity. VIG is a market cap weighted, meaning larger companies hold more weight in the ETF. VIG's index uses a 3-month median daily trading volume threshold of at least $1 million. The last of the index rules are SCHD focuses on companies with a market cap of at least $500 million, ensuring only well-established firms are included. VIG removes the top 25% highest yielding companies, which focuses on sustainable and growing dividends rather than immediate yield. Beyond the index criteria, SCHD applies 4 key fundamentals: cash flow to total debt, which is the ability to repay debt with cash flow; the return on equity, basically profitability; dividend yield, which is income relative to stock price; and 5-year dividend growth rate, which is consistent dividend increases. These ensure SCHD holdings are strong dividend payers, financially solid, and capable of sustaining payouts. Meanwhile, VIG holds every stock in its index through full replication of the index, providing broad exposure to dividend growers. SCHD debuted in October 2011, offering a 13-year track record that covers a few market cycles. VIG has been around since April 2006, providing more historical data for investors to evaluate. SCHD has shown resilience, while VIG offers a broader historical perspective. Both SCHD and VIG have an ultra-low expense ratio of just 0.06%. For every $10,000 invested, this amounts to just $6 in annual fees, making them cost-effective options for long-term investors. In assets under management, VIG leads with $97.3 billion in AUM, making it the #1 dividend ETF. SCHD ranks number 3 with $49.3 billion. For comparison, Vanguard's VYM holds the number 2 spot with $70 billion in assets under management. These rankings reflect the broad appeal and investor confidence in these dividend funds. SCHD offers a 3.49% yield, higher than VIG's 1.77%. SCHD is ideal for those seeking immediate income, while VIG's lower yield emphasizes long-term growth. We'll dive deeper into dividends later in this presentation. Both ETFs pay dividends on a quarterly basis, providing regular income streams for investors. Both SCHD and VIG are passively managed, mirroring their respective indexes with minimal intervention. Passive management helps keep costs low and also avoids the pitfalls of active stock picking. SCHD has an annual turnover rate of about 28%, indicating a slightly more active rebalancing approach, while VIG has a turnover rate of 13%. That signifies a more stable long-term approach. VIG's average market cap is $188.96 billion per company, suggesting a preference for larger, more established companies. SCHD's average market cap is a lower $78.98 billion, offering exposure to slightly smaller companies, but still substantial in size. Another major distinction between these two ETFs is their market cap allocation. SCHD allocates 65% of its portfolio to large cap companies, with a significant 28% in mid cap stocks. This blend of large and mid cap gives SCHD exposure to well-established companies while tapping into the growth potential of mid caps, which are often in their expansion phase. On the other hand, VIG places 83% of its portfolio in large cap stocks, emphasizing more established companies with stable revenue streams. Only 14% of VIG's assets are in mid caps, reflecting a more conservative growth-focused approach. This contrast highlights SCHD's broader exposure, while VIG prioritizes stability and steady growth. Let's dive a little bit deeper into the stock style of these ETFs. SCHD leans heavily into large cap value stocks at 41%, focusing on undervalued companies for stable returns and potential price appreciation. It also includes mid-cap value at 15% and mid-cap blend at 13%, which gives a balance of stability and growth. While VIG takes a more balanced approach with large-cap value blend stocks at 42%, targeting a mix of value and growth, and it also holds large-cap growth stocks at 19%, favoring companies with strong earning potential. These differences show SCHD's value focus, while VIG blends growth and stability, which is appealing to different investor profiles. SCHD holds 99 stocks, focusing on high-quality dividend-paying companies. VIG holds 339 stocks, offering broader diversification across companies with consistent dividend growth. SCHD's top 10 holdings make up over 40% of the ETF's total assets, reflecting its concentrated approach. Leading the pack are Lockheed Martin at 4.5%, AbbVie at 4.4%, and BlackRock at 4.2%. These companies are well known for their financial stability and strong dividend histories, which align with SCHD's focus on income-producing assets. Following closely are Coca-Cola, Home Depot, and Cisco, all of which are large-cap companies with consistent payouts. Rounding out the top 10 are Amgen, Texas Instruments, Bristol-Myers Squibb, and Verizon, providing SCHD with diversification across healthcare, technology, and consumer staples, further cementing its income-driven strategy. The emphasis on these top performers help SCHD maintain a steady yield. VIG's top 10 holdings, while representing a smaller percentage of overall portfolio compared to SCHD, are dominated by tech giants Apple at 4.6%, Broadcom 3.9%, and Microsoft at 3.9% are at the forefront, showcasing VIG's tilt towards tech, where companies not only dominate their industries, but also have a record of increasing their dividends over time. Financial and energy sectors are also well represented by JP Morgan Chase, 3.4%, and ExxonMobil, 3%, while United Health Group, Visa, and MasterCard add further diversification. Rounding out the top 10 are Procter & Gamble and Johnson & Johnson. Companies known for their consumer-focused products and consistent dividends. VIG's broader diversification of 339 holdings gives it a wider net, making it less concentrated in any particular sector than SCHD. Let's now turn to how SCHD and VIG differ in their sector weightings. SCHD is more heavily weighted in financials at 18.26%, reflecting its focus on stable income-generating companies. Healthcare is the second largest sector at 15.99%, followed by consumer staples at 14.62% and industrials 11.7%, which rounds out its defensive positioning. SCHD also leans into energy 11.93%, with notable exposure to oil and gas companies known for strong dividend payouts. VIG places more weight on technology at 23.77%, which is significantly higher than SCHD, which showcases VIG's growth orientation. Financials comes in at 20.21%, followed by healthcare 16.04%. VIG's emphasis on tech reflects its strategy of targeting companies with consistent dividend growth. Both ETFs exclude real estate due to the non-qualified dividends real estate companies issue, but their divergent sector allocations illustrate SCHD's preference for stability and immediate income, while VIG aims for long-term growth through tech-heavy exposure. Let's dig deeper into industry exposure. SCHD and VIG reveal distinct strategies. SCHD focuses on traditional income-generating industries like biotech at 15.9%, oil and gas 11.2%, and banking 10.4%, prioritizing stability and reliable dividends. It also has a defensive tilt with beverages at 7.8%, while VIG emphasizes growth, such as specialty retail at 7.6%, semiconductors 7.6%, and biotech at 7%, aiming for capital appreciation alongside dividend growth. This shows SCHD's focus on stability, while VIG seeks growth in dynamic industries. All right, let's talk about dividend yield, a key factor many income-focused investors care about. SCHD has a dividend yield of 3.49%, which can be appealing for those interested in higher current payouts. On the other hand, VIG has a yield of 1.77%. While it's lower than SCHD, VIG focuses on companies with a strong history of growing their dividends over time. Even though the initial yield is smaller, this strategy targets long-term dividend growth. This highlights two different approaches. SCHD prioritizes immediate dividend income, while VIG emphasizes growth over time. Let's take a closer look at the dividend yield history of both SCHD and VIG over the past decade. Starting with SCHD, you can see a steady increase in dividend over the years from 2.6 in 2014 to an average of 3.45 in 2024. Notably, SCHD's yield consistently stays above 2.5%, with significant jumps in 2020 and 2021. On the other hand, VIG shows a more conservative yield, starting at 1.93 in 2014 and reaching 1.81 in 2024. While VIG's yield has remained relatively stable over time, it clearly trails SCHD's yield, which aligns with VIG's focus on dividend growth rather than immediate high payouts. This historical perspective highlights the differences between SCHD's emphasis on higher yield and VIG's more growth-focused approach, offering investors two distinct strategies depending on their income or growth preferences. Let's shift our focus to dividend growth rates. Over the past 3 years, VIG has demonstrated stronger dividend growth at 11.79% compared to SCHD's 9.01%. However, over the 5-year period, SCHD takes the lead with a 12.99 growth rate, surpassing VIG's 10.34% growth rate. Looking at the 10-year, SCHD continues to outperform with 11.1%, while VIG follows with 8.57%. This comparison highlights VIG's strong short-term dividend growth, making it a good option for investors seeking a mix of dividend growth and capital appreciation. However, SCHD's strength lies in its ability to provide sustained dividend growth over long periods of time. Looking at dividend yearly growth history, SCHD shows standout growth in 2019 with 19.79%, in 2020 with 17.64%. VIG had strong years in 2014 and 15 with growth of 14.19 and 14.76. While its growth is steady, it trails SCHD in recent years. Feel free to pause this video here if you'd like to take a closer look at the chart. All right, let's break down some key value and growth measures between SCHD and VIG, starting with price to earnings. For SCHD, we're looking at a P ratio of 15.22, which means investors are paying $15.22 for every dollar of earnings. That's pretty typical for a value-focused ETF. Now, VIG has a higher PE at 20.09, which shows investors are willing to pay more for the potential growth that VIG companies bring to the table. So here, SCHD leans more toward value, while VIG is really about growth. Next up is price to book. SCHD's price to book ratio is 3.04, which tells us its holdings are priced closer to their actual assets, really hammering home that value focus. VIG, however, comes in with a price to book of 4.12, meaning investors are paying a premium for those higher growth companies. Again, value for SCHD, growth for VIG. Let's talk about price to sales. SCHD has a PS ratio of 1.78, meaning investors are paying less for each dollar of revenue. In contrast, VIG's PS ratio is 2.32, showing that investors are paying more for that growth potential. Now for price to cash flow, SCHD has a PCF ratio of 10.08, which suggests are valued reasonably based on cash flow. On the other hand, VIG's PCF is 16.26, indicating investors are banking on future cash flow growth. As you can see, when we compare these measures, you can see SCHD value, VIG growth. Let's shift gears to growth measures. We'll compare long-term earnings, historical earnings, sales, and more. Looking at long-term earnings growth, VIG leads with 9.18% compared to SCHD's 5.94%. So here, VIG is definitely targeting growth while SCHD sticks with reliable income. When it comes to historical earnings growth, VIG again takes the lead with 6.59%, while SCHD actually shows negative 3.34%, emphasizing SCHD's focus on value stocks that may have seen slower earnings growth. For sales growth, VIG comes in with 9.15%, while SCHD shows 6.2%, reflecting steady, stable growth. As for cash flow growth, VIG leads again at 8.76 compared to SCHD's 2.46%, which again highlights SCHD's focus on stable, well-established companies. And finally, we have book value growth. VIG shows 7.24% growth in assets, while SCHD is similar at 6.47. Both ETFs clearly focus on maintaining strong financial health. As you can see from these charts, in value metrics, it's pretty much SCHD, and in growth metrics, VIG leads in every growth metric. Let's dive into the backtest results and see how both SCHD and VIG performed over time. Starting with a backtest from 2012, we see that by 2024, SCHD grows to $48,794, while VIG is just behind at $47,146. Not a huge gap, but it shows how both ETFs have delivered solid returns over the long haul. SCHD's slight edge reflects its focus on higher dividend yields, while VIG's consistency comes from its dividend growth strategy. Now, taking a look at the compound annual growth rate, we see SCHD leading with a 13.14% growth rate, while VIG is just slightly lower at 12.84%. Both ETFs have performed remarkably well, with SCHD offering a touch more in terms of overall growth. Next, let's compare the yearly return percentages. As we see in 2013, both ETFs had a great year, with SCHD returning 32.93% and VIG not far behind at 28.9%. In 2019, VIG had its best year, returning 29.66%, while SCHD followed closely with 27.4%. Over the last 2 years, VIG has outperformed in a different market environment, showing its strength in adapting to changing conditions. In more challenging years like 2022, SCHD managed to limit losses at negative 3.36%, while VIG dropped further with a negative 9.87% loss. SCHD's income-focused strategy showed more resilience during market downturns, whereas VIG's growth focus made it more vulnerable to market volatility. Finally, looking at monthly contributions, if you were to put a certain amount in every month since 2012, whether it's $100 a month or $500 a month, both ETFs demonstrate strong growth potential. With $100 a month, VIG slightly outpaces SCHD, reaching $40,163 compared to SCHD's $39,609. When bumping up to $500 a month, VIG closes at $185,636, with SCHD not far behind at $180,894. So no matter the contribution level, both ETFs have delivered significant gains. Overall, this backtest shows us that while SCHD has a slight advantage in high yield and market resilience, VIG holds its own with consistent dividend growth and capital appreciation, especially notable in its best years, 2013 and 2019. And its outperformance over the last 2 years in a changing market. It is important to remember that past performance is not indicative of future results. So while this backtest from 2012 gives us a valuable insight into how these ETFs have performed, future performance will depend on a variety of factors. As we've seen throughout this comparison, both SCHD and VIG offer strong returns, but they cater to slightly different investment goals. SCHD shines with its focus on higher dividend yields and resilience during market downturns, making it a solid choice for investors seeking more immediate income and stability. On the other hand, VIG stands out for its consistent dividend growth and capital appreciation, especially during bullish markets and evolving market conditions. Ultimately, there's no clear winner. It all depends on what aligns with your personal investment strategy. If you're focused on income and stability, SCHD might fit your portfolio better. But if you're looking for long-term growth and rising dividends, VIG could be the one to consider. Just remember, past performance is not indicative of future results. And as always, it's important to evaluate both ETFs based on your financial goals and risk tolerance. I think we'll end it there. Thanks for watching. Hey, if you found something in this video that you haven't seen in other videos, give me a like, subscribe, let us know in the comments which ETF fits your investment strategy best. Keep investing smart with ETF Fundamentals.